Okay, good morning, everybody, and welcome to the second in this webinar series on looking for growth outside Australia, filling out the growth part of the portfolio um, without thinking about the large cap US stocks that are so dominant. Now, yesterday we focused on infrastructure and Japan as alternative sources of growth investments. Today, we're going to be looking at emerging companies, emerging markets, names that you haven't heard of. And in a moment, I'll hand over to Jason Petras, our moderator for the series. But before I do hand over to Jason, let me just remind you of a couple of upcoming events for IMAP. Tomorrow, we'll be moving away from listed markets altogether, and with Adam Myers from Pengana and Kieran Canavan from Centric, we'll be looking at private markets as a source of the growth component of portfolios. And then in October, on the 8th of October in Melbourne and on the 15th of October in Sydney, we'll be hosting our Independent Thought Conference, the opportunities for us to really examine a range of parts of the portfolio. In Sydney, we'll be joined by Alan Kirkland, Commissioner from ASIC. And as those of you who have no life and read the ASIC corporate plan will know, ASIC have this year called out managed accounts as an area that they'll be paying some attention to. And so I'll be talking to Alan about what that attention is likely to mean. We welcome you, of course, asking questions, and we had a number of excellent questions yesterday. So please, as we venture into the sort of less familiar territories of emerging opportunities today, please don't hesitate to send in those questions. And now it's my pleasure to hand over to Jason Petras from Resonant Asset Management, our moderator for the series. Thanks, Jason.
Thanks, Toby. So for those that joined yesterday, we, as Toby said, we discussed Japanese equity markets and we looked at global listed infrastructure. So today we're moving into looking at emerging markets and also looking at global smalls and mids. So we've got two managers to discuss their respective funds. So initially, just going to set the scene a little bit, because one of the points that was made yesterday was actually around the valuations, and how different earnings have been working, throughout the sectors. So and regions. So I just wanted to bring up this slide to, I guess, show some relative equity premiums and expected returns within the region. So you can see how the US is very anemic, I guess, in terms of those expected earnings and equity premiums across the spectrum, and that's a combination of the prevailing interest rates, the profiles of the growth profiles of the company, then also the current valuations. And the US obviously being quite relatively overvalued. You can see Australia in the mix there on the lower end as on a relative basis as well, but we've really got some sort of standouts there through Japan and emerging markets as being areas that are definitely worth consideration. So. And then just onto the next slide too, please. So just looking at how that looks across sectors. So this is particularly looking at the S&P 500, relative to the ASX 200 on our major gig sectors, and you can see there how we do, sort of tend to see a much broader representation of earnings and EPS expected growth across sectors. So in Australia, we were discussing yesterday how financials and materials, even though they're very large weights in the Australian index, that we've really been seeing pretty low growth and opportunity in those sectors. When you look at the S&P 500, you can see there's a much more uniform sort of spread out earnings profile there across companies. Obviously, energy, is still under there on a relative basis. but it does give you you know, a bit of a sense of the diversification that we get when we move outside of Australia. Um, so a couple of things that we really want to focus on today I guess in the discussion, the Q&A is going to be around you know, I guess the deglobalization or potential deglobalization we're seeing from US policy, how that's impacting and knocking on to some of the broader you know, allocation thinking within some of the managers. And also what we want to discuss around is, you know, what really drives the stock and selection process for a lot of the fund managers. It's common that when people start talking about smalls and mids and emerging market, that it all seems to be about growth, and people want to allocate into those markets because they see them as being very high growth markets. But it's not always the case, because value actually really comes into play in a lot of the allocations. So I'll let Joel and Rakesh you know, discuss this more. But initially, we're going to hear from Joe Connell from Bell Asset Management, who's going to give us a run through their fund and how they approach the investment process. So over to you, Joel.
Great, thanks, Jason, and thanks everyone for your time today. Looking forward to sharing some insights on the global SMID cap segment of the market, which we think is underappreciated and filled with a lot of great investment opportunities, many of which are off the radar for a lot of investors. So let's begin on the next slide. We'll define what we mean when we're talking about global SMID caps. So there's often misconceptions that associate them with speculative startups or thinly traded local companies, but the reality of global SMID universe is very different. They're much more robust than many might anticipate, especially if you're comparing to, say, Australian small caps, for example. So the MSCI World SMID Cap Index, which is a proxy for the universe, is made up of the bottom 28% of the market cap across 23 developed global markets. It includes over 4,600 individual companies. And in terms of size, the vast majority of these companies sit between US $1 billion and $50 billion in market cap. So maybe just to make a comparison to stocks in the Australian market, there's currently only about 9 ASX listed stocks that have a market cap above US $50 billion. And there's plenty of household names like Woolworths and Telstra that are below this level. So global SMID caps include some sizable companies in the context of Australia, but on a global scale, they're still very fundamentally different to what you find in the large cap part of the market. So for example, the MSCI World Large Cap Index now has a weighted average market cap of over $1 trillion. So ultimately, the global SMID universe is perhaps larger and more mature than many people realize, but importantly, it still offers a really unique set of investment opportunities to what you might find in the all cap or the large cap strategies. Let's move to the next slide, please. Now, one of the key benefits, like Jason alluded to, was allocating to SMID caps for diversification. I appreciate that diversification hasn't exactly been in vogue lately, given that some of the more concentrated bets, especially in mega cap US tech stocks, have done very, very well in recent years. However, it is crucial to remember that while concentration can have big payoffs when things go right, it can just as easily transform into a material headwind if market dynamics shift or if a handful of stocks begin to falter. So bringing this closer to home by first looking at the Australian market, if you look at the ASX 300, the top 10 stocks now make up nearly half of the entire index. CBA alone is over 10%. And if we add together the financials and materials sectors, you're looking at over 50% of the index in just 2 sectors. So a lot of concentration risk, as you probably know. And it is a similar story in global large caps in terms of concentration. So the MSCI World Large Cap Index, the top 10 names are now over 30% of the index. And perhaps more striking is that they contributed almost 60% of the total return of that index in 2024. So that's pretty staggering considering there's nearly 600 companies in that index. Now, by contrast, the global SMID cap universe is far more diversified across sector, stocks, and geographies. So the top 10 stocks in the SMID cap index make up just under 3% of the total. And because passive flows tend to funnel into the largest names, this has arguably exaggerated the rally in large caps. So if we saw those flows reverse, it could easily become a source of indiscriminate selling and put pressure on some of these names or indices. So we believe, for those that have benefited from some of these more concentrated bets, reallocating some of those profits to other segments like global SMID caps makes a lot of sense to us. And we'll see on the next slide that diversification doesn't have to come at the expense of sacrificing returns. So looking over the long term, over the past 25 years, global SMID caps have actually outperformed global large caps by about 1.2% per annum. It may not sound like too much, but thanks to the power of compounding, that does translate into substantial differences in total returns over time. Now, the logical or natural next question is, well, what are the underlying reasons for this? Why have global SMID caps delivered superior returns over the long haul? And we'll touch on that on the next slide. So one of the most fundamental and enduring reasons for this long-term outperformance is simply the growth. So global SMID caps have consistently delivered faster revenue and faster earnings growth than their large cap peers, and they're forecast to continue doing so looking forward. And we think this faster growth is a durable characteristic of this segment of the market due to their structural advantages. So they're often earlier in their life cycle, have a longer runway for expansion, more white space opportunities to capture share. And SMID caps are often more agile and better positioned to innovate, which means they can often pivot more quickly to new trends or respond to competitive threats. So we think that these characteristics really do combine to create superior revenue and earnings growth, and that compounds over time into the higher shareholder returns. So we'll move to the next slide, please. Now, beyond their better growth profile, another fundamental and often underappreciated advantage of global SMID caps lies in the inherent market inefficiencies. So we often refer to these companies as hidden gems because they're significantly less picked over by the broader investment market. And we've got some data at the bottom of this slide to back that up. So the chart on the left shows that on average, a company within the SMID cap index is covered by only 9 sell-side analysts. Now you contrast that with the Magnificent 7, which has over 70 analysts on average, or if you look at the top 50 global stocks, about 40 analysts on average. And so these analysts are the ones that are scrutinizing every quarterly report, every press release, and every market rumor. And so the difference in information density and analytical attention is quite stark. And as you can see on the chart on the right, about a third of the SMID universe has 5 or fewer analysts, and nearly 2/3 have fewer than 10. So ultimately, that means that these companies are frequently under-researched and consequently under-owned by institutional investors. And for skilled active managers, this presents opportunities as there's often more mispricings to take advantage of. Now let's talk about valuation on the next slide and why we think this is a particularly attractive entry point right now. So if you recall earlier, I showed the chart of SMID caps historically outperforming large caps over the long term, but over the last 5 to 7 years, SMID caps have actually lagged mega caps and large caps quite materially. Now, interestingly, this underperformance recently has not occurred because their earnings or their fundamentals have been weaker, but it's been almost entirely because their valuations have sharply diverged. So the data on this slide helps to illustrate that dislocation. So the global SMID cap index is currently trading at about a 15% discount to large caps. And this discount is particularly noteworthy when you consider that the SMID caps have delivered superior earnings growth over time. So essentially, you are getting higher growth for a significantly lower price. And if you compare it to the large cap growth index or the Mag 7, the discount widens to almost 40%. And historically, SMIDs have actually traded at a premium to large caps. So we think this dislocation at the moment is notable, and we think it does create quite a compelling setup looking forward. And we'll move to the next slide, please. So maybe just to bring the concept of great global SMID cap companies to life, on this slide, we've got a few real world examples of market leading businesses that we either own in our portfolio currently, or we consider to be high quality names that we'd love to own at the right price. You might recognize a few of these names, but I'm pretty confident that you won't. A few of the names will be new to you, hence the title, The Best Companies You've Never Heard of. I won't run through them all, but let's just maybe look at a couple of examples. Auto Trader and Rightmove, for example. These are fantastic examples of dominant, high-quality businesses, very much like Australia's own Car Group and also REA Group, but operating in the UK market, both below $10 billion market cap and still off the radar for many global investors. Then we have a company like Viva Systems in the bottom right corner, which is another compelling example of a fantastic company that you've probably never heard of. So they provide cloud-based software solutions for the life science and pharma industry. One of their products is the CRM, or a Salesforce type software for pharma sales reps. And they have over 80% market share. And over the past decade, their earnings have grown at an average rate of over 30% per annum, and plenty of runway for growth still ahead. So a very high quality company, but one that's certainly not a household name. There's also a couple of really interesting Japanese names: Obic, an ERP software firm with strong market share in the SME space, and Disco, which operates in the semiconductor supply chain. So I'm happy to talk all day on these stocks, but I'll leave it there and happy to field questions on these during the Q&A. The key point here is that there are many amazing examples of companies that are dominant in their respective fields and yet still largely live under the radar of many generalist and large cap investors. Maybe just on the final slide, we'll summarise why we believe the case for global SMID caps is built on multiple compelling pillars. So you've got, as we spoke about, the attractive valuation, so currently trading at one of the largest discounts in over a decade, the superior growth, and that's expected to continue moving forward, the diversification benefits, which I think are particularly important given the concentration risk inherent in the Aussie market or in the large cap indices, the alpha potential, so obviously the market inefficiency and the limited coverage means that active managers can hopefully exploit this to generate superior returns over and above the underlying asset class. And there are multiple tailwinds that we see, various catalysts, interest rate cuts, better clarity on tariffs that we think could be supportive for global SMID caps. So when you put it all together, we think that global SMID caps offer a really compelling opportunity for strong risk-adjusted returns and certainly warrant a serious look for your client portfolios. So hopefully that's given you a decent taste of why we're so excited about this segment of the market. I'll be more than happy to answer questions during the Q&A session, or please feel free to reach out anytime to myself or my colleagues at Bell Asset Management. So with that, I'll pass it back to Jason. Thank you.
Thanks for that, Joel. So I think one of the interesting things that Joel and I actually talking before the start of the session there was a number of the key stocks that he highlighted them were actually Japanese names. So again, off the back of yesterday's session, Japan's definitely sort of starting to come back on the radar a bit for a lot of managers. So the next presenter is going to be Rakesh, who is a portfolio manager from Pzena. Now Rakesh is joining us from New York tonight, so it's about 10:30, I think 11 o'clock over there, Rakesh. So thanks for joining us so late. And I'm sure it's been an interesting week with the UN in town as well. So we'll hand over to you and give us a run through emerging markets.
Of course. So hello everybody, and thank you for taking the time. I'm Rakesh Bordia, and I'm from Pzena Investment Management. Pzena Investment Management is a very simple company because we do one and only one thing. We build bottom-up, concentrated, deeply researched portfolios with a fairly long-term holding, call it 3 to 5 years. That's all we do around the world, and we have the same philosophy, same team, and same process to build these portfolios. The starting universe is different. So for EM, it's the EM universe. For something else, for global, the global universe. We have been investing in emerging market stocks since 2004. We launched our EM special strategy in 2008. And in terms of our philosophy of the investments we are looking for, it is grounded in 3 core aspects. Yes, we are deep value managers, but not to be confused with buying crap. So the first and foremost criterion for our investments is we want
Rakesh, it's Toby here. Could you just go a little closer to your microphone? The sound has just dropped off a little.
Oh, sorry. Just give me 1 second, okay?
Thanks.
Is this better?
Yeah, much better. Thanks.
Okay, sorry about that. So in terms of our philosophy, which is grounded in finding businesses, first and foremost is we only want to invest in really good businesses. By good business, a business which has significant competitive edge versus its peers, better cost structure, better technology, better scale, but something which stands out. in terms, and generates higher returns than cost of capital over a cycle. Number two, we only want to invest in these businesses when they're in the cheapest 20% of the universe. And this is where our deep value pedigree comes in. And the number three is very strong downside risk management, because a lot of these businesses may take a very long time to normalize. So that's our underlying philosophy, and we have applied this philosophy and process to emerging markets in our portfolio for the last 20 plus years. Now, in terms of the question we get a lot on emerging markets, it is, does value work in emerging markets? So if you can go to the next slide. I would argue, in fact, that is empirical evidence that value actually works better in EM than anywhere else. And here is why. If you think about why value works, it works because investors overreact, they get overly fearful, and that creates the price dislocations that investors like us can capitalize on. So this chart on the left-hand side is developed market, where the darker bars, the blue bars, are basically showing the relative outperformance of the cheapest quintile of stocks versus the most expensive quintile over a 1, 2, 3 year time frame. And as you will see on the right hand side, it actually works really well in emerging markets. Because if you think about it, the fear factor when investors get scared and are willing to sell these companies at very, very cheap valuation is just much higher in emerging markets. Also, in the more developed world, value is either working or not working. It's highly correlated. But in emerging markets, the underlying diversity of countries is so high that 3 years ago, Eastern Europe was cheap. 2 years ago, China was cheap. Last year, Brazil was cheap. So there is a continuous alpha potential opportunity in emerging markets. So if you go on to the next slide, it kind of, so we don't have data which we can use. So we use our portfolio data to illustrate this point. But what this chart shows is it shows the rolling 5-year return since the inception of our strategy in 2008. So essentially the first time period is Jan 08 to Jan 13. Second is from Feb 08 to Feb 13. And what this is trying to show is that if you invested in our strategy at any point of time over the last 17 years, and you held it for 5 years, how would you have done? And what you would notice here is that it's basically of the 151 time periods, our strategy outperformed almost 90% of the time when value wasn't working 95% of the time. Value is working is aligned with what we call as the contracting time period, when the spreads are contracting. So there have been very few time periods in the last 151 time periods that we looked at. And if you see, it outperforms the MSCI EM value index in 100% of those time periods. This is not to say that, okay, we are geniuses or we are doing something really crazy. It goes back to what I was talking about. If you combine emerging markets investing with a very disciplined value investing approach. Disciplined is key, because you can't get scared at the wrong time and you can't get euphoric at the wrong time either. So you have emerging markets, you have a very disciplined value investing approach, and you have a long-term orientation. It is just a very, very powerful concoction. And if you do that, it's really an all-weather strategy which works in almost all situations in all time periods. Because value and emerging markets, disciplined approach, long-term orientation works really well. And if you go to the next slide, what it shows is that is a great backdrop to invest in value stocks in emerging markets. And on top of that, you have a kicker right now that the discount of emerging market equity versus developed market it's kind of at a very, very high level. Almost an all-time high if you go back 30 years or so. So not just that, it's a good time to be an investor in emerging markets, it's also a great time to be investing in emerging markets value strategy from that standpoint. The last point I would want to make is, if you go on to the next slide, is the other benefit of investing in value stocks in emerging markets is that if you pick a disciplined manager, they tend to be fairly counter-cyclical to where the market is. This chart just shows our weight in China in our portfolio over the last several years. And if you go back 3 or 4 years, 4 years ago, it looks like distant memory now, but world was in love with China. And at that point, there were not enough deep value, cheap stocks in China that we could invest in. So our portfolio was significantly underweight China, where the index was almost 40 to 43% of the emerging markets was in China. Now, fast forward that as China underperformed the rest of emerging markets by a whopping 60-70%, because we were able to buy lots of businesses on sale in that time period, because they were basically sold out for dead. Our weight in the portfolio went up from an underweight 20% position to an overweight 10% position. And that is the beauty of investing in a value strategy, that it is just going to be much more counter-cyclical to the index-driven, more kind of pro-cyclical strategies overall. And as a result, many of our managers pair us with other managers, because we really have very low correlation with other managers which are not value investors. So all in all, if you put it together, I wanted to highlight that if emerging markets is a place where value works really well, this is a great time to be investing in emerging markets overall, given the valuation discount versus developed world, as well as it actually provides a very good ballast to the rest of the portfolio, given its counter-cyclical nature in emerging markets. I'll stop here. If there are any questions, I'm happy to take them later on as you have them.
Thanks, Rakesh. We actually do have a question first up, which, while you're on, we might as well address that first. But yeah, so the question was just around whether the valuation discount that we're seeing in emerging markets is basically a function of large caps being overvalued, and how that compares to historical rates. But I think in your slide previously, this one has actually pretty much explained that yes, it isn't at all time widespread now, but it has actually been at those levels for quite some time.
That is partly the reason that especially the US market, which has been at astronomical levels driven by Mag 7, that has compressed the valuation, or increased the valuation discount, versus not just emerging markets, but also against Europe and to a certain extent even Japan. And so that is accurate, but that is why the opportunity set in all these markets is actually much better than it's in the US markets right now. And I can talk all day long about Mag 7 and what they're getting credit for without showing the results and how much free cash flow they are spending on it. But that is an accurate observation, that is part of that outperformance is showing that up in the discount in emerging markets.
Yep. Thank you. So you've mentioned Mag 7, so we might as well get up on that, initially. But I think one of the big I guess themes or drives in the market in the last few years has been this pretty crazy ride on the Mag 7 and really that market leadership. To give you an idea, I guess to provide some relatives for the audience. The Mag 7's expected AI infrastructure budget, I think over the next sort of 12 to 8 months, is something like $500 billion US collectively. Now that's close to 50% of Australia's GDP, give or take. I mean, the numbers are absolutely, astronomical. And I think, for both Rakesh and Joel, it'll be interesting to get your take on, how your respective market segments are really going to compete, within that space where you have these like dominant tech players that obviously have and are moving more and more through AI towards pricing power. They're controlling a lot of that underlying business infrastructure. Is there the ability within EM and within SMIDs to be able to continue to, realise margin expansion, realise EPS growth, when potentially and arguably you could say that they're starting to, maybe lose a little bit of control around their cost bases, and they may be crimped and a little bit restricted in effectively getting those benefits of scale over time. So I know that's a long question, but maybe start with Joel as to your thoughts on that.
Yeah, it's a really good question, and there's no doubt that many of the mega cap tech stocks are great companies, and they've delivered exceptional returns, over the past 5 and 10 years. Now, for us, in terms of looking forward, one thing we would sort of point to is that there is going to be a deceleration of that earnings growth in the Mag 7. So I think over the past sort of 5 and 7 years, they've compounded their earnings at over 30% per annum. And the returns from a shareholder point of view have been even more than that because you've had valuation expansion as well. Now, if you look over the next couple of years, I think the Mag 7 forecast earnings growth is only around 12 to 13% per annum. So quite a material deceleration in the earnings growth. We compare that to, say, the global SMID-cap index, where the earnings growth is expected to be closer to 14 to 15%. So effectively, you're getting higher growth at a big discount. I mean, the SMID-caps are trading at a 40% discount to the Mag 7. So there's certainly, it's not necessarily a question of the business models and so forth, but the expectations are elevated. We do see the case that you've got to be selective in terms of the companies you invest in, and there's a big debate at the moment around companies that are going to be disrupted by AI versus companies that are going to benefit. But there's certainly a lot of companies we invest in the small mid-cap space that we beneficiaries. They will incorporate the AI into their businesses to drive margin expansion, to drive efficiencies and improve their margin profile. They're not necessarily the ones doing the huge CapEx spending like the big hyperscalers, but obviously, it remains to be seen whether they're going to get the return on that investment. And that's the big debate now. I mean, we saw, we had the DeepSeek sell-off earlier in the year. There was a lot of questions around the return on that AI-related investment. And that drove a sharp, it was only a shorter-term drawdown, but it was a sharp drawdown at that point in time. And so anything that happens that puts some questions around the return on the AI investment could easily cause these Mag 7 and some of these bigger stocks to sell off. So maybe that's my perspective. I'll pass over to Rakesh if he's got other thoughts.
No, I mean, I think end of the day, I agree with you that it's a lot of it is about valuation. Yes, Mag 7 are great businesses, but they are spending, as you said, $500 billion a year. And because the last cycle of cloud investing was a success, the market is saying that everybody will be successful by spending all this money. I mean, every time they increase the CapEx, actually the valuations go up even higher. So they are all priced for perfection. And as a result, what is being left out is really not pricing. And if you think about it, the hardware that comes for a lot of these chips made by Taiwan Semi, Samsung, a lot of those companies are in emerging markets. There are also a lot of hidden gems in emerging markets. We owned a company called Elite Material, which basically makes substrates for the AI servers. It has a monopoly in it. It was a very small business 4 years ago, but after the AI took off, it was really big. So if you can really deeply research these businesses and identify these free options in these businesses, there's great opportunity and value in these businesses. And by the way, all these Mag 7 are doing these AI investments. Who are they going to sell these to? To companies to improve their operations. So there are businesses, as Joel earlier mentioned, which are going to benefit tremendously from this AI spending, and they are not being priced as companies that can improve their operations and margins over time. And so in a way, you have a tale of two cities where one part of the world is already given credit for all the success, and all the things which they will do, which is going to impact the rest of the market, is kind of fallen behind. And that's what creates a huge opportunity for investing in all those forgotten part of the market.
Yeah, no, they're really good points. And I think, what we see a lot within, I guess, mid-size, even small-size companies, as well as EM, is that the AI capabilities that they're able to bring in, and it's not necessarily being the pointy end of developing models or being those large sort of infrastructure plays. It's more about the actual use cases and the benefits they're achieving. And to put it into sort of software development terms, you're taking probably a highly capable software engineer within a startup firm, and they're probably 10xing their capability and output, so they can deliver to market faster and realize those benefits in a much quicker way. So we do think that opportunity and I guess that scalability of a lot of these smaller firms, time to market, development risk is probably contracting, and then there's probably a lot of gems out there that haven't been realised within that context. And we're even seeing that, like in even in the Australian equity market. I think some groups are starting to see compression of cost base, or at least accelerating their delivery timelines quite aggressively because of those benefits. So it makes for a quite a rich hunting ground, I guess, in that respect. So just shifting gear a little bit, I think indexation is another area that I think we all are very well aware of, and I think especially within Smiths, Joel, you tend to have this effect where the company's getting bigger and bigger. They're sort of like they're potentially leaving your universe to a degree once they go into an S&P 500 or a large cap, and then you sort of get this acceleration away because all the money's flowing into that. So you have that size benefit. I think for both, and Rakesh is probably getting similar sort of dynamics within EM to a degree, although it's probably not part of your process at all. But what are your thoughts on how that indexation, I guess, plays out in your mindset? Is it something that you're thinking about when you're looking at the larger process overall? So again, Joel, we'll start with yourself.
Yeah, sure. I mean, I certainly agree that indexation and passive investing is here to stay, and we probably get closer to a point where it's more steady state in terms of the penetration. But when it comes to global SMID caps, I mean, indexation is far less relevant because it is a much more diversified universe. I mentioned earlier, there's over 4,600 companies in the index, for example, and the largest companies in the index are typically only 20 or 30 basis points. So you don't have the same level of concentration risks and the passive flow type influences that you get in, say, the Aussie market or in the larger mega caps. In terms of how it impacts or how we think about it from a risk management or portfolio construction point of view, obviously sometimes these flows can create distortions in the market because the share prices can become more driven by flows as opposed to fundamentals and some of the factors that we think over the long term drive share prices. So for active managers, it can be great because it can drive mispricings that you can hopefully take advantage of. But it's certainly important. You can't ignore the flows. You can't ignore some of these sentiment or psychological factors that can be more influential in the concentration of the market. But it's something, I guess it is a little bit less impactful within SMID caps. And I think, like I said in my prepared remarks, I mean, the investors need to remember that passive flows, can have a positive impact when flows are positive and provide tailwinds for share prices and valuations. But if you see flows reverse, you really can see indiscriminate selling. And when you've got massive concentration risk building, that is a risk that I think investors need to be cognizant of.
Yeah, I would even stretch the argument a little bit and say that actually passive investing is from an alpha generation standpoint, actually it can be a benefit because it is very pro-cyclical. People chase returns, and when, as we saw I mean, yes, it has worked well for Mag 7. It has, the concentration has gone up, but eventually, as the valuations between the most expensive part of the world, because everybody's chasing it, and things which have been left for dead get stretched, that is exactly the opportunity which is really attractive for investors like us. So in emerging markets, the indexation is not as severe, though there are few names which are really large. And in terms of how we run our portfolio, it's purely bottom up with almost no regard to what the index concentration or composition is. We are basically building the portfolio bottom up with each stock into the portfolio on its own merits. So our active share is typically between 80 to 95%. And as a result, indexation we see it more as an opportunity versus a threat. And as you saw with the China chart, I showed that world was in love with China. China index weight went up a lot of money flowed there and wasn't attractive enough. And when it became attractive, it has been a source of alpha creation for the last few years.
Thanks, Rakesh. No, that's really really interesting, and I think we're always conscious of it. And the big question is, why not just go passive into this space? And we're big believers, at Resonant, of using specialist managers within these areas because there are genuine opportunities out there. And if you're going to spend fee budget, then these are the sorts of areas that you need to be focusing on and picking those high quality managers. So.
What Joel mentioned earlier as well, like the whole active management space in emerging markets and in SMIDs is because it's not well covered. The data is not available. There's a lot of language reporting differences across countries. So somebody who can really delve deep into these businesses and understand the fundamentals, can actually create a lot of good investment returns because it's not as well understood as the large caps in the US would be.
Yeah, yep, no, absolutely. So just again, so a couple of questions we're getting from the audience. So this first one, so EM's had a strong performance recently, but over the longer term, it's they're saying 3 to 5, 7 years, etc. It has been a struggling segment of the market. So I guess this is really coming back to, and Joel will talk about Smiths as well in a minute. But I guess Rakesh, what are you seeing as the catalyst? Like, where do you really see that the next 3 to 5 years allocating to this space is can give us a genuine benefit relative to I guess MSCI World as a passive allocation effectively.
Yeah, if you actually look at emerging markets returns over the last 3 decades, if I say the first decade of the century, emerging markets really outperformed developed markets. The next 10 years, they really underperformed. And the last 5 years has been an underperformance, mostly driven by what has happened in US and more recently in Europe and Japan. And if you parse it even more, a lot of that performance is driven by what has happened in China. If China really did well in the first decade and has basically languished in the last 10 to 15 years, and that has been the biggest driver of returns in emerging markets. And as a result of that, the starting point of valuations in China and in emerging markets is in a very, very attractive place. That today the earnings yield of the cheapest quintile of the universe is in mid-teens. Versus you look at lots of other parts of the world. I think Joel was talking about, the mega 7 is like, 12%. That's just the earnings growth. It's not earnings yield because they're trading at very high multiples. So the dispersion with what emerging markets value offers today is really significantly better than what we can get in lots of other markets. So we are very energized by the opportunity and the position of emerging market stock right now overall.
And I think something that we just add to that as well, when you look at the side, I mean, part of the reason that I guess, Mag 7 and those large caps attract a lot of money is because there is liquidity and scale and people sort of feel safe in the herd. But I think, the China example is a good one where when that sentiment shifted, like a lot of allocators were so underweight into China and so underweight in the EM, we saw this quite explosive turnaround. And I think you probably know better than me, Rakesh, but I think the HSCI was up something like 50% in 3 days or something. So, when that money shifts and even a small amount, it can have a massive impact on those market moves. So, Joel, I guess broadly again on that same tactic question. Where's the catalyst for SMIDs and what do you think of I guess give us the top couple of pointers that you think are going to drive the markets in that space?
Yeah, sure. So, I mean, in terms of catalysts, I mean, I kind of briefly mentioned in my remarks, I mean, we think cutting interest rates, we think getting more clarity on the macro environment, better clarity around tariffs and so forth. There has been a certain level of pause on spending, particularly in the US market, given some of the macro uncertainty. And during times of uncertainty, you do sometimes see people flock towards the large caps over the small mid caps. So we think over time, as we get more clarity there, that could unlock people to move back into small mid caps. We think, obviously, I mean, ultimately, it's going to come back in the long term to the earnings growth, the superior earnings growth opportunity. And in terms of what will drive the outperformance moving forward, we think that the deceleration at the end of the large cap and the acceleration in small mid cap earnings will be one of the catalysts that really drives that. Also, I think one of the things, in terms of small mid caps, M&A activity has been quite subdued over the last couple of years. And small mid caps are typically net beneficiaries of that activity. Usually it's the large caps that are trying to buy other smaller companies to supplement their growth. So as we see that M&A activity come back, we think that could be a catalyst for the space as well. And we've spoken to a lot of investment banks, and we've got some holdings in our portfolio, Partners Group and Houlihan Lokey, that sort of benefit from this sort of M&A activity. And we hear that there is a lot of pent up demand for deals. And now that we're seeing rate cuts start to come through, that could be one of the things that really catalyzes that growth. So ultimately, we think, there's various different areas. And like you mentioned, Jason, often it's a snowball effect. So if we see SMID caps start to outperform, and already this year to date, they've had pretty similar performance to large caps. But if we see SMID cap start to outperform for a period of time, then what you do see is you start to see a rotation in market. You see the asset allocators, put some more investments in the space, and it can become that real snowball effect. And what we're hearing from our institutional clients and asset allocators, there's a lot more interest growing in the small mid caps, and partly just because the valuations and the great returns have been made at the large cap end of town. But we do see it as being sustainable in terms of superior returns over time once they get going.
Yep, absolutely. So another question we've got is just what the expectations are in both strategies from a beta perspective if US large caps were to re-rate. So I'm assuming that the sort of underlying part of the question there is if US large caps re-rated in, I'm assuming on the way, in the direction of de-rating, not going any higher. But yeah, what do you think would potentially be knock-ons, and how do you think the dynamics would shift there? So Joel, you're on a roll, so we'll stick with you.
Yeah, sure. I mean, typically, small mid caps are higher beta, and what you often do see is that they are a bit more volatile, and on the downside they can produce a little bit more downside. But more recently we saw in the Liberation Day sell-off in April, small mid caps actually outperformed in that market, and I think that's a function of where we're coming from, a starting point in terms of valuations and expectations that small mid caps, like we've said, very attractively valued. They've got good fundamentals. So as much as they are typically higher beta, we don't necessarily see that the case going forward. You do see them; they often rebound much faster as well on the way up. And for us, we're quality focused investors. So what we want to do as part of our investment approach is address that risk. We know that they can be a bit more volatile, these small mid caps, but we think when you have the quality overlay in the space, that makes a lot of sense. And in our track record going back, nearly 10 years managing this small mid cap strategy, we've delivered very good downside protection, so a lot of outperformance when markets have pulled back. So we think investors can address that through active management, particularly going with a quality manager.
Thanks. And Rakesh?
Yeah, I think for emerging markets, it's really not that critical in terms of, the emerging markets kind of dances to its own tune for the most part, and it hasn't benefited from the whole upswing in the Mag 7, except maybe some names like Taiwan Semi and the whole semiconductor supply chain. But beyond that, it's really a very vast majority of businesses are local businesses which are driven in their own country, whether it's banks or industries. So for emerging markets, I think that doesn't have a direct impact. I think what it might do is, as you mentioned earlier, Jason, that if people get less excited about the US large cap market and the funds start moving out to other markets, that can have a huge impact in the performance of these markets. But from a fundamental standpoint, the relative impact of what happened in the US is not ginormous for most of the emerging markets.
Yeah. And we discussed this briefly yesterday in the session that the Aussie industry funds were sort of quoted in the papers recently as having shifted from sort of they were saying, oh, we're reallocating out to international markets, and they'd moved like 2% from where they were. So I imagine that's probably the beginning of a reallocation cycle, which doesn't happen overnight, and they can't. So it's got to be very very gentle. So I've just got there's just one other question we'll sort of ask around sort of your longer term themes in 1 second, and you're thinking. But I just got the last question from the audience actually for me was just around proportion of global equity allocations to be putting into SMIDs or EM. So look, I mean, this is obviously a little bit there's a bit of interpretation around I guess where you're getting your SMID exposure based on the funds you're using, etc. But so that's really a blended question, I think, and what you're if you're using an active manager, how they're utilizing the SMID space, because sometimes that does get scooped up into some larger cap type of strategies as well. But particularly with EM, for us, it's sort of sitting at around about an 8 to 9% of your global allocation at the moment. So we are pretty strong believers in that valuation argument right now. And I think also within the SMID space, we do think that there's a lot of opportunity within that as well. But again, it's sort of you've got to unpack and understand how your actual manager is using what sort of universe they're considering. So, as we discussed right at the start, from Joel's comments, that a SMID on the global level is very different to a small cap in Australia. So, it's really about definition as well, from that point of view. So hopefully that answers that question. So I really just got another 5 minutes, guys. So I'll sort of try and keep this to sort of 2.5 each on the responses. But really just to round it out, and I asked both the managers yesterday about this, but if we're looking, really now over sort of 10-year horizon, what's the one, I guess, secular theme that you think is going to drive returns within your portfolios? And how are you exposed to it now? Is it something that's sort of on the radar going forward? But really that real longer term look as to what you're thinking is going to drive your particular strategies. Rakesh, we'll start with you.
Yeah, so I mean, emerging markets, as you mentioned, generally because of the population trends and just improving governance structures, there are better and better companies coming up from emerging markets. I mean, if you go back 25 years ago, there were no industry leaders in emerging markets. Today we have in tech, in automotive, and in different industries. So a lot of these are the fundamental drivers of how, why the valuation of assets in emerging markets should continue to go up from a secular standpoint over time. Now, of course, that is a broad trend, but within that, the opportunity will always be driven by finding the areas where that is not already priced in. And a good example of that is India, for example, where the fundamentals are solid, large middle class, democracy, growing, growing population, the economic structure, labor laws are improving. But then you look at the valuations of that market, there's so much optimism priced in that you can be right about all the structural elements, but you might still not make money in that market. So while the fundamental trends are all going to be structurally good, it's still going to be a stock pickers or a research-driven investor market in emerging markets for the foreseeable future is how we see it.
Yeah. And Brazil's one of your overweights, correct? So, so maybe just give us a little, like 30 seconds on that.
Yeah, Brazil has one of the biggest Lula discounts, as I would call it. And I'll give you a simple example of a company, Banco do Brazil, which is a bank in Brazil. It is trading at close to half times tangible book. The lowest ROE the bank has made in the last 20 years in a given quarter is 11%. And so if you believe that the bank makes 11% in perpetuity, the lowest it has made in a single quarter in the last 15 years, then the stock is not, then you're not going to lose money in the stock. But if it generates anywhere close to what it has, their long-term history is around 17, 18%, then the stock is very, very cheap. We believe it can generate 14%. It's a good industry structure with 4 banks controlling 70, 80% of the market share. So we believe they can generate 14, 15%. So then it will be a very good stock. So if you look at the discount is so heavily in the stocks that in the worst case scenario, you don't lose a lot of money. In almost every scenario that you can imagine, you can make a lot of money. And that's the kind of opportunities we are finding in Brazil right now. And again, it's not because we like Brazil top down or from a macro standpoint. It's just that because the discount in the stocks is so high, given Lula's policies or concerns about the elections coming up next year, that we are able to buy these stocks at bargain prices.
Thanks, Rakesh. Joel, so 10 years down the road, sitting around having a coffee, what worked? What was the big drivers?
Yeah, it's a really good question. I mean, we're certainly not thematic investors, and we're very much bottom-up investors, and so ultimately there's going to be a range of different thematics or drivers, whether it's from healthcare to software to automation to AI. And for us as bottom-up investors, we want to have quite a diversified spread across getting that exposure. But you do want to be on the right side of things in terms of getting tailwinds from these industries. But for us, it's really just identifying the quality companies that can ultimately continue to compound their earnings growth over time, and often irrespective of what the external environment's doing. And that's what we're trying to do. And we think from a standing start today where we sit, quality has actually, in developed markets, has actually had a really tough time over the past 12 to 18 months. And so we think there's many amazing quality companies that are on sale right now. So we think investors, you can just buy these quality companies and they can compound their earnings over, the next 10 years. You'll make some very strong returns. Maybe just to put a stat around that, I mean, the MSCI World Quality Index has lagged the MSCI World Index by 10% over the 12 months to 31 August. I think if you look over the last 20 years, that the biggest year of underperformance for quality was 4% in terms of calendar years. So it's a massive outlier at the moment in terms of the recent performance of quality. And that's really a function of people it's a very much a risk on mentality. At the moment, people are chasing some of these sort of cyclical value areas of the market, or some of these, you think about these meme stocks and some of these unprofitable tech stocks. There's a lot of money just chasing these riskier areas of the market. And it means that there's some really great quality companies that just have, great tailwinds longer term, but that are on sale right now. So, that's what we would say. That's where we think we're going to make money over the next 5-10 years, just buying these quality companies.
Yep. Okay. No, that's good. Good response. So thanks to both of you for those. I know there's a lot to discuss there. There's a lot of tricky questions. So we will call that a Q&A session over. So we'll hand back to Toby, and really wanted to thank both Joel and Rakesh for your involvement today. So I know a lot of prep goes into these. So really appreciate you contributing.
Pleasure. Thank you.
Look, I just want to reiterate Jason's thanks, Rakesh, especially to you for staying up late. Joel, not so much an issue for you. It's
the most fun thing I've done at 10 p.m. at night in a long time. So it's all good.
All right. Look, thank you very much, and to all of you who have attended, thank you for your time and staying with us. Tomorrow, as I mentioned, we'll be moving away from the listed markets, and we'll be focusing on the opportunities as part of the growth segment of the portfolio that are increasingly available from private markets. Those of you who've attended alternative sessions or listened to the private markets will know the mantra that 90% of all companies, 90% of all market capitalization is in companies that are not listed. And tomorrow we'll be talking about the opportunities that they might give rise to for this part of the portfolio, and then for independent thought in October. So thank you for your attendance, everybody. We'll look forward to having you join us tomorrow for Adam Myers, Kieran Canavan, and Jason, to you coming back again. So thanks very much.
Thanks, Toby.